If you're a reinvestor, let me share with you what has happened. In July, REIT markets actually found an unexpected bottom. It rallied from the lows all the way to September 2024. That was when Fed actually cut rates and signaled that inflation may indeed have been defeated. Short and long-term rates actually fell, and REITs actually surged 20%, and this feel-good factor continued for another month until October. Then something happened, correct? A small correction. Why? I think that can be explained with the possibility of Donald Trump winning the US election. Long-term rates started to climb as early as start of October, and by November 6, when Donald Trump's victory was confirmed, long-term U rates climbed further. The consequence? The Singapore index fell even more. So today, let me share with you some optimism. It isn't over for REITs. It's not going to zero. Don't worry about it. And I'll also share with you what I think are simple buys. Now in the market, it's all the talk of long-term interest going up again because of the new US president. But if you think back, just 1 year ago, everything was talking about because of Fed rates going up, REITs have crashed. And maybe with hindsight, we have more data now to refute that. Let me pull up a chart that I've developed myself. The IHS REIT Leaders Index against Fed Fund Rates. If you're interested in investing in the IHS REIT Leaders Index, you can actually buy SRT. And this index actually tracks the biggest and most liquid S-REITs in Singapore. Or you can check out Lion Philippe S-REIT, which is CLR, non-investment advice. This is also highly popular and can be found on today's sponsor Moomoo's platform. Later I'll share a bit more on what they have in terms of promotional offer right now. What I'd like to highlight is back in 2016 to 2018, there was a green arrow up, correct? REITs actually climbed in the period when Fed rates were actually going up. Then in 2019, that was actually the best period for REITs. Fed rates were stable and coming down slightly, but REITs were really shooting through the roof, gaining 20% in that year. Fed rates stayed low, and subsequently in 2022, as we know, Fed rates started to climb aggressively. That is all in history already, but what I'd like to focus you lastly is this red box on the right hand side. What do we realize? Fed rates have been stable, correct? And it actually did come down in the last 2 months. But the REIT index has been yo-yoing up and down, correct? So with this information, it clearly dispels that Fed rates and REIT prices are totally correlated. It's not. Maybe there's some effect to it. And with this, we need to find a deeper reason, correct? And I've actually found it. Before I share with you, help me smash the like button. It's taken our team hours to prepare this presentation for you. And hopefully if you're a reinvestor, it reinforces that long-term investing wise, we are going to see bumps along the way. Yes, I do understand it's a disappointing leg down again. I'm also invested in markets and like to speak to the entire REIT community that there will be sunshine. So thank you very much, and let me next review what is the bigger correlation for REITs, which is actually the US 10-year bond yield rates. But when I put them together like that, you can see the picture a lot more clearly. Let's recap again. 2019 was a golden period for REITs. It surged up 20% when Fed rates were stable and slightly declining. But what you would realize is that the 10-year rates were actually tumbling in that very year. Again, this is what I boxed up in orange from 2019 to 2020. COVID period saw the 10-year rates still at low amounts, and REITs were actually doing pretty well. But what do we realize? In late 2022, even before Fed rates started to climb, the US 10-year rates already climbed. That is in the red circle over there. And this climb actually shocked the REIT market, and there was a big correction. REITs have yet to fully recover from this trauma itself. And moving forward again, we'll see two arrows that I pointed. Whenever US 10-year rates come down, REIT prices rally. And conversely, when it goes up, REIT prices correct. The recent correction is seemingly again a correlation to this 10-year yield rate. With that clarified, let's explain the reason. Why do REITs seem to correlate more with the long-term rates, than the US Fed rates? Long-term interest costs actually affect REITs more than short-term interest rates. As shown over here, OU has actually borrowed in a 3-year bond at 4.25%. So they don't actually borrow on a month-to-month basis. They lock in rates for multi-years. And with that, let's next answer the question. Josh, I agree with you. If REITs have a stronger correlation to long-term interest rates, and if Donald Trump's policies make long-term inflation go up, wouldn't that be bad news for REITs? If you Google search very quickly, you would see that there is mixed opinion. Some believe that Trump's policies are more inflationary because they have tariffs, they are very protectionistic. But some believe that interest rates are determined by economists and will go down anyway without regard to who was the president. The more you read into it, the more confused that you may get also. So with that, let me pull up some wisdom from Howard Marks, which he has shared in a recent interview with Bloomberg. And let me quote, "Be less aggressive, but don't exit the market. Nobody can time the market, and instead calibrate your behavior between aggressiveness and defensiveness. You can be right about the events, but wrong about how the market will react. There are many speculations about the new administration, but the truth is, nobody knows how it will play out." Keep that in mind. I think predictions of what would happen in the next 1-2 years because of Trump is just a coin flip. You remember when Fed raised rates, everybody, all the economists were speculating that this would confirm make the world go into a global recession. But instead, we haven't seen. US stock markets have been up 20 to 30% ever since the bears of 2022. And when Donald Trump won in 2016, many experts believe there was a meltdown moment, like an America Brexit. On hindsight now, that totally was not true. So don't focus too much on market predictions and don't bank all your happiness as an investor absolutely on it. If the market is with you, that's great. But when the market is against you, remain patient. Speaking about remaining patient in REITs, right now as an investor, you will be paid 5 to 6% to wait. REIT prices can be said to be distressed right now. On the other hand, if you buy a fixed deposit, you will get 3%. But also you need to wait for one entire year before you get a 3%, right? It's just that when you buy a fixed deposit, you'll definitely get that moment, 3%. But when you invest in REIT, the journey will be up and down, up and down. But at the end, you still get double of what you get in terms of return from dividends. Let me pull out the summary table to highlight some STARR names. At the top of the distribution yield, you see ARA US Hospitality, Prime US REIT, EC World REIT, iREIT, Capital Pacific Oat US REIT. These are REITs which have assets overseas, like in US and UK. The rental situation is different, the currency situation is also different. I believe they are a bit more speculative and probably not the easiest idea for long-term investors. I cropped up 3 names who have good sponsors that should be on each REIT investor's watch list, and they are Maple Tree Industrial Trust, Fraser Centerboy Trust, and CapitaLand Integrated Commercial Trust. As you can see, they pay around 5 to 6% right now. In my opinion, the 3 of them will show growing dividends in the coming year ahead. There are other big REITs, it's just that they are in different sectors, and the sector that they happen to be in may be facing some headwinds. For example, Mapletree Logistics Trust is China warehouses, and the demand over there looks a bit weak. Then Mapletree Pan Asia Commercial Trust is Festival Walk, which is a Hong Kong mall. Business over there looks a bit weak. So each REIT has its own dynamics, but these 3, I think the chances of their operations doing well in 2025 looks pretty good to me. I hope the share price will also reflect that, and therefore I'm invested in the Mapletree Industrial Trust and Fraser Centerpoint Trust. For the REITs that I've mentioned, you can actually find them on Moomoo. Simply go to Markets, tap on SG, tap on REITs, and that's where you can find a drop-down list of all the best REITs that you can invest. With Moomoo's platform, you can actually get information of the company's financials, revenue breakdown, and their stockholder information in a quick glance. Moomoo has one of the lowest trading fees for Singapore stocks, no dividend handling charges, and also no corporate action charges. So if you want to sign up now, use my referral links below. On top of that, you'll be able to unlock 4 stock bundles of top 5 traded US stocks worth $70 each and an Apple share worth $287. Still got one more offer. If you use my code, you'll get an extra $20 cash coupon. Also, Moomoo provides a facility for Moomoo Cash Plus to park your idling cash. For new users, you can enjoy 6.8% per annum guaranteed return for 30 days from Moomoo Cash Plus, which means you can get $447 for the first 30 days if you park $80,000 inside. On this point, do note that Moomoo Cash Plus is not comparable to a fixed deposit. 6.8% guarantee is for the first 30 days and principal is not guaranteed after. For more terms and conditions, refer to my description box below. So what are you waiting for? Sign up with Moomoo today. Coming to here, if you have questions, let me know in the comment sections. And I've seen typically questions like these also. Hey Josh, REITs 5 to 6%, that's good, but non-guaranteed, correct? Answer is, that is true. This is an investment. REITs own real estate and the business is leasing out real estate. And when they do so, some of their tenant contracts are actually multi-years. Mapletree Industrial Trust, for example, signed something that is 20 years and auto-escalating, recession or not. So the dividends per unit, in my opinion, can be forecasted quite accurately. The thing that we cannot forecast is of course the share price and the market sentiment. The second question is that, hey Josh, REITs have to pay out as dividends 90% of its income. It cannot grow its dividends per unit, correct? I've been hearing this quite a bit, and this 90% payout used to be a benefit. No need for shareholders to put pressure on management to decide on the dividend payout level. 90% decided, and not just that, there is a tax transparency with that qualification based on the REIT mandate. So this is not a negative. And the point of it not being able to grow its dividends per unit, actually when a REIT wants to make acquisitions, what they'll do is they'll call for funds, correct? They pay the dividends, and then when they see opportunities, they sell shares against to raise money to buy new properties. That is actually how they grow the dividends per unit. An example is of course CICT, which has recently acquired ION from its parent CapitaLand. You see over here, they called for money, and after the acquisition, they believe they are able to generate more dividends per unit for its investors. And take note again, when they launched this, the REIT sentiment was pretty good. The preferential offering unit was at $2.07. Right now, CICT is trading even lower than that. So when it was announced all was sunny, today, dark clouds have surrounded REITs again, and it's all doom and gloom. But it's the same ION Mall, correct? So if you're a CICT investor, if you like this acquisition, isn't it an opportunity to buy more? I think that's food for thought. Something I've also shared in the Telegram group. When you buy REITs, you buy real estate. When you buy CICT, you get a piece of ION and Raffles City. I've known Raffles City since I was young. Traffic was strong there, traffic is still strong today. Traffic will still be strong 10 years later. And rent, naturally, will still be strong 10 years later. What we don't know is whether a sponsor can manage costs correctly. And costs not only comes from interest expense, which is where macro headwinds come about, that cannot be controlled. If you can tolerate uncertainty from these factors, it's actually a very simple investment. On the other hand, let's use some examples as comparison. And one is, for example, PayPal. Share price for it hasn't gone anywhere in the last 5 years, and PayPal is just one household name that could see its business disrupted by AI or crypto. I've raised this to highlight. Investing is more than a price action, it's about knowing your asset. I'll share these frequently on the channel, and as always, if you haven't subscribed, make sure you do so. And I have further points to add also. When I look back at my reinvesting journey in the last couple of years, I started buying the REITs, especially in 2023. Back in 2019, I was sounding caution on it. But since I built my portfolio with REITs as a key component, I realized also that I was being paid to wait. Returns are not dependent only on share price movement. So let me pose that question. And if we were to pull up the chart again, what if there is a time where long-term interest and inflation starts to cool back to 3.5%? Does that mean a 30% upside for REIT values? It could be, correct. Nobody knows when it will get there or how the journey will be. Maybe there could be a slowdown in economy, recession comes about. But this is by no means a stretch of imagination. And that leads to today's title. It's really not over for REITs. Look for opportunities in this downturn. As always, thank you for watching right at the very end. And let me introduce you to some of my previous tutorials. Why my biggest holding is Mapletree Industrial Trust right now. Let me introduce you there, and I'll sign off from here. Take care as always. Goodbye.